What does history suggest happens next? Markets have just hit a 3-year high in breadth and we're outside of the daily Bollinger. Today we explore what's happening moving forward with the data that you need to know as a trader and investor. We'll also be looking at new opportunities on the horizon. Small caps were doing well and there are some sleeping giants going on in the markets right now. Join us as we cover stocks, commodities and cryptos together. Well, welcome back everybody to the Daily Show. My name's Tom. Today we're discussing the macro, the lead indicators, and the hottest charts that are going around in the markets right now. Remember to subscribe if you love markets like we do. Comment down below and hit that bell icon. It really does help us out. The big stories over the last 24 hours, the Reddit IPO. Do we have a 2021 style market again where everything's flying up over 30%? And AMD entering a technical bear market for the first time. Is there structure on the horizon? We'll take a look at that, along with Apple and the DOJ investigation that isn't bearing well for the actual stock. Of course, it's already been selling off for a while, so it's likely someone knew about this before it occurred. 429 stocks just hit a 52-week high on the New York Stock Exchange. The last time that happened, June of 2021. And you can see here it marks the highest rate in over 3 years. So what does the data suggest happens next? Well, let's have a look here at the breadth indicator, which is often considered very important. Of course, percentage of stocks above the 20, above the 50, and the 200 went back to 80%. And there was huge rebounds across the board after the Federal Reserve's decision this week to potentially not stop the idea of a June rate cut. Guess what? We just also saw the Swiss Central Bank come out with a surprise rate cut of 25 basis points. And while the Bank of England didn't follow them, it does show you that there's this tendency towards this for the rest of the year. Do we have a little bit of data for this read? Turns out we do. And of course, the data suggests that the markets will rip higher. In this case, over the 2, 3, 6, and 9 month periods, we're generally going to be moving towards a bullish stance. And of course, 100% of the time over 6 months with similar reads, we were higher to a double-digit number. So does that mean there's no dips? Well, we'll talk about how dips do still occur during these numbers, but they are quickly purchased. So we'll have to find out whether some kind of flash sell happens at any point. What about when we have 80% breadth reads in general? Well, here are the last couple of reads. There have been some sideways market actions during these points, but we'll look at the Bollinger as well soon on the charts. So you can kind of see how that's going to be an important read, I think, as well, if the markets are going to get super overbought. Returns from the Bollinger. So we're above the daily Bollinger, and that usually means that we're starting to get a little bit of extended. But funnily enough, over a 1 month, 2 month, and 3 month reading, it really has no difference. And there's not too many reads here. It's kind of rare to do this, but the weekly will be the important one. We'll look at that in just a moment. Another thing is that will the Fed cut while we're at these super highs in markets? Well, according to Carson's data here, you can see that, yes, they have done that before. And funnily enough, when they do it, there is a 1 month return that's actually quite negative around the cut. And then most of the time when it's at all-time highs, they actually end up driving much higher prices. And the reason is quite simple. It has to do with their cutting, but they're cutting into growth scares, normalization, or just in general, cutting into still a relatively strong market, effectively the no landing or soft landing scenarios. Now, we do know there's one read that we're going to need to look at very closely, which is, of course, the US 2-year versus US 10Y. We know that markets very rarely actually freak out until that uninverts, and at the moment it's been inverted for, I think, the most in recorded history so far. So which one will it be? Well, generally markets rip into the actual cut themselves, and the data is starting to suggest that that's still going to be there, although we'll be looking at price action. And of course, at the moment, single stocks and sectors remain the major opportunities across these markets. Let's take a look at the sentiment reports. Of course, Bank of America is coming in 6.5, not quite at this sell signal yet for Bank of America. And we did see the recent sentiment report come through, which does show us the bears increase. Now, this report closes around Tuesday, so this was ahead of the FOMC, and people were turning obviously quite bearish into that event. There was no price action, obviously breaks to suggest it, but people went from being neutral into the bearish side and a little bit of bullish into the bearish side. So that's probably why we ripped a little higher. I would say that a lot of CFDs were offside during that event. What about rotation? Well, some of the favorite sectors of many retail traders came back, but I am seeing a nice movement here in metals and materials. And we've been talking about this a lot. And it's really nice to see metals and miners coming through. In some ways, it's a semiconductor style play because we will need some of the rare earth materials and obviously quite a few other things to get this whole thing underway. And it's a segment that I think shows us that we could be moving into stagflation or even reinflation very, very soon. KRE's done well, and home builders. We'll talk about this sector moving forward because home builders may be just beginning a further rip, and there's a lot of action going on in home builders. ITB now 6.39%, XME 4.43%, and you can see a lot of the sectors we've spoken about still pretty nice in that rotation. So let's go into the charts here, and we'll start off with the weekly because I want to talk about weekly Bollinger Bands, and this is the S&P 500. And the analysis so far is that, of course, the market has continued to rip, and it's gone through the daily resistance. It's gone through the 5200 gamma level, and that's ripped it straight into 5250, which you're going to find out very soon is an incredibly important new positive gamma level. And if 0DTEs get through that, it's probably going to cause further squeezes. Now, where the actual Bollinger matters is going to be the weekly one. And if we get a weekly with similar reads to what we had down here, it suggests either a pullback in time is coming or we're getting a pullback to possibly even that magical weekly mean reversion, which we haven't seen in a very long time. For now, though, markets remain very bullish, and you can see that on the daily, it is outside of the Bollinger. It gapped up, it held the high, although it did go red through the session. And there are some gap fills to be had here, which may be met by bull demand. So I think that 52.24 of the previous session could act as a bit of a support over the next 24 hours or even a later period. But notice the gap. So if we have a look at the 5-minute chart and we take a look at what actually this is suggesting, if we hold up here and we stay between kind of 52.40, 52.60 zone, and we just kind of chop through here and then we gap down, that's going to be what we call an island reversal candle. Now, it could signify a movement back to the daily 20 moving average, which we know has been purchased so far. And the daily 20 moving average is the most important indicator in overall bull-bear swing in terms of how we're seeing it move forward. What are the key levels that we need to be watching on the futures action? You can see here 52.50 is the big res. We break through this, 5300 becomes the next level, and it's just a further squeezing of the options. And we'll go through that in a moment. Some other big zones that you'll need to be looking at from bears, 50.93, 50.50, they remain the big bear targets. And of course, that gap fill on the SPY could be something that maybe buy the dippers will be looking at on the intraday. Let's now go over to the options market. This is where things get, I think, very interesting. 52.50. Look at this level. It's so heavily traded right now that dealer books will have to actually hedge this off by buying futures, and they'll basically push it up to the 5300 zone. So 52.50, a breach above here is going to push that 5300 narrative. But this is for all expirations. There's really no negative gamma switches yet in markets. And we know that unless we get a negative gamma switch, at least on the options market side, and that's a lot of the flow at the moment, it's unlikely we're going to be able to see that sell-off. So along with the technical price action levels, if we can follow options, which we're doing here on the channel, then that will help us quite a lot. Take a look at the next couple of sessions though, the 22nd Friday. Look at the 52.50 zone. Absolutely struck like wild. If we get through that, again, squeezes because of the hedging that needs to be done are most likely going to occur. You can also see the 25th 52.50 also being the most struck level, and again, causing potential squeezes to occur from that zone. 5300 now becomes the biggest level for the OPEX in April, and the markets are still in the positive gamma environment. So there's no reason yet, at least from the options side, to say there's weakness there. What about net worth? Now, this brings into a discussion about why this decade or why the next couple of years are going to matter so much. We've actually seen an acceleration of net worth over the last 3.75 years, which is very, very quick. But notice the 10-year periods before this. Now, I believe there's a 2-decade style cycle concept. And what we're seeing in this case is the secondary one, which tends to be lesser overall percentage, but still just as hyperactive as often it has been in the other ones. So are we ahead or are we in schedule? We're actually pretty much on schedule a lot for that. And one of the reasons I'm saying this is because when we take a look at the debt market, have a look here at mortgage rates. So you might think, oh, mortgages must be harder to get. Well, we'd be dead wrong on that one, because it's actually easier now to get home loans. And I've been rabbiting on about this and talking a lot about this in our Monday live shows. If you ever want to join us for the Open, you can do that, subscribe, and we do it every Monday for the stock market open. And you can see here that actually it's easier to get loans across the board. And what that's doing is it's leading into a basing in confidence for existing home sales. Now, remember before we talked about ITB and home building is getting wild. Well, one of the reasons is a chronic undersupply. And this is a big problem in the economy. And obviously it's going to lead into some, I think, reckless building and all sorts of things that are going to go on. But we have an undersupply. And what that's doing is it's putting pressure back on probably the most important market in the world, which is realistically residential real estate. And that's improving in terms of recent sales from February. Now, some other things that have been improving is this. And of course, what this is LEIs. So we went into negative territory on this during 2022 and 23. And for a lot of people, this was a sign that a recession is coming. Now, as we know, recessions tend not to actually occur until the US 02Y actually goes and uninverts itself from the 10Y, which we've talked about a lot. But this is actually now going back into the positive side, and that's again decent for growth stocks. You can see here LEIs also upticking in recent reads across the internet. Another one is credit card debt, and there's two ways to look at this. One, you could say credit card debt going up and delinquencies going up a little bit is bad. A lot of the time, the delinquency reading is actually going back to where it was pre-pandemic. Getting much above that is going to be a huge issue. But it's interesting to see where the spends are suffering. Furniture, well down, but some things actually up. And we're actually seeing 1.1% year on year ending in March 16th week ended up being positive for credit card debt. And why this is because markets are at all-time highs. Crypto's up, and we've got stock markets up, and we've got most assets up. That's making people more confident, and they're taking on the debt in some of the most important sectors for growth. But of course, we're seeing it in that property market in particular. Now, what's this good for? Well, it could be good for materials. And you can see here materials versus the S&P 500 have started to rebound pretty heavily. We've been all over this one, and we've actually seen XLB here break out to new highs. On top of this, we've got all of those metals trades starting to improve, and it's going to be specific. But as part of the semiconductor revolution and, of course, AI, these could be sectors that we start to look at on the show. And, of course, we will be, so make sure to subscribe for it. Let's look at some other things. Are equities traders overweight? CTAs are, but they are only part of the storyline. You can see here that a lot of so-called smart money is actually behind the eight ball here in terms of being in the markets. They may need to act on that at some point. Next week is Good Friday. Obviously, that's the end of the quarter. So obviously what happens, or often what happens, we get a lot of window dressing that goes on around those times. It'd be interesting to see whether we start to see even more improvement there in terms of equities traders getting near those all-time highs. They're certainly not near overexposed. This is a bit of a blurry chart. Sorry to put it in, but are small businesses planning to hire? It's dropping off like a rock. And what that's telling us is that overall, we're going to see probably unemployment spike. And this is partly why the Fed, I think, is doing what it's doing right now. So, in many ways, we're probably going to see unemployment spike. And that means the Fed's going to act on it. And we could say all these different things, but let's just be real. They're trying to create as much stability as possible in the markets during the election year. What about uptrends in forward earnings and sales? Well, you can see here 12-month forward earnings. Overall, a very, very strong kind of growth here, at least on what Wall Street believes it is. Ultimately, if Wall Street is correct, then they're going to be happy. If they get it wrong, it's going to be bad. But they look in the future. And as we've often said, stocks trade 12 to 18 months in the future. So they're loving these forward sales. They're loving these forward PEs. And they're all looking at it from everything's going to be great and fantastic. Of course, stretch valuations are there, but as we know, in hyper bull markets, we can get easily above 25 forward PE. And at this stage, we're not quite there, though I did post over on our X the difference between tech and the rest of the market. The actual underlying still sits around 17 to 18, which could again present more opportunity, which we're starting to see in the Russell and some other things. Come from that abundance mindset, it does help us out, because there's always another opportunity around the markets. Take a look at the UK, for example. It's actually trading really heavily down, and that's because this whole rally has been predicated on AI. Let's go through one of my favorites right now, which is obviously gold. I've talked about this chart before. Central bankers are purchasing gold out of control at this point, and they're doing it because we're probably in what we call a currency war. We also see generally gold perform quite well into rate cuts by the Fed, and it performs pretty well after the rate cuts by the Fed, which I do think leads into some interesting times for gold overall. Now, have households missed out on the gold move? Yes. And I'm getting people even messaging me that are out of nowhere. Oh, should I get into gold? Should I get into Bitcoin? What's happening here is retail in general has not been on this move. Now, I'd like to think that a lot of members of this community, you guys have been analyzing these charts together, and hopefully there's been some nice moves there. But households have missed out on the move overall. And in general, gold has been, of course, improving. Another thing is that a lot of people are going through the charts and saying mining ETFs suck in comparison to gold long term. And the truth is, yeah, they do suck in general. But you'll notice there are times when they get heavily correlated. And that was last decade, or 2 decades ago. So basically during that tech bust into boom. Now, I think we're in a similar time based on what we're seeing in potentially the metals and copper charts and also undersupply of buildings. And this is very interesting kind of switch. When we get to these types of ratios, they can be things that we can take advantage of, long, short style scenarios. And of course, over, let's say gold outperforming gold stocks outperforming gold themselves. What about Bitcoin? Well, have we started to see an acceleration of movements out of it? The ETF showing 2 large downflows as probably some profit taking is happening. Over on X, there's some comments down below, though, by a few members that have got some great charts showing that a lot of exchanges have seen upticks. But it's a pinnacle point here for the halving cycle. And often there is a dip before the halving cycle. Is this going to keep dipping? We know our key levels. We'll look at them later. Risk on, risk off ratios, obviously showing still risk on across the board. And this is another one. The growth of the high yield bonds versus treasury bonds. People are seriously taking a lot of risk on the markets right now. And you can see it here across the board, going back up to this very important ratio where we've tended to see treasuries do better than the high yields. Now, we know the high yields are coiled. So if we get a break to the upside and it ends up being false, then that's going to be another sign that maybe the bears are coming back into markets. For now, though, that's not happening. Regionals, anything to do with basically high yield and risky debt is being loved by the markets. Super regionals are still trading at a massive discount to the overall big banks. I still think that over the next decade, we're going to see a huge reduction in banks. And what that's going to do is concentrate the debt into a couple of institutions. Eventually, someone's going to do something bad. And that's going to be where the cracks really start to show. Let me know if you agree with that concept down below. We've talked about it again in our Monday shows a few times. Here are the last 100 days converted. It's about 5 days out of date now, but you can see that we often do go into kind of sidewaysy markets over these periods. There have been some nice ones, though, where markets have ripped higher, such as this line here, which was back in 2010. And then we had nice little dips. And are we due a dip? Yeah, we are. Of course, we would love to see a dip because I'm sure a lot of you want to get in on this market. It hasn't happened. We've been looking for it. Obviously, price action has dictated that we can't get any dip till we get at least below the 20-day moving average. So all of those are rips at this point. It's been 90, probably 5 days, and it's on average 67 between a 5% section. It is due, but the bigger ones are not due yet based on previous statistics. Let's now move over to the unusual trading activity. As we mentioned, Apple did have some trades on it the other day. I don't know if that's foreshadowing the bad news, but maybe an area that some structural traders will want to look at over the next 24 hours. Selling off 4%. It already sold with this massive trade. Clearly someone knew about it. So Apple's sold, it's underperforming. Maybe it will start to look better though. We'll have to watch and see. A new low though. Apple's in a double top and it's going to look really bad. Tesla did see a large trade. Dropped a little bit in today's session. If it does come back down to this level, I'd love to see another big circle. If that happens, really positive, of course, for Tesla. Let's move over to CTAs. So CTA is still a little bit lower on the NASDAQ, so that's definitely the weaker of the major indices. Then we have the S&P absolutely skyrocketing. This thing just blew straight up after seeing that drop ahead of the OPEX. And then we've got gold actually reducing. So maybe gold's going to struggle here a little bit, but silver has stayed up. And we will look at the chart for silver soon because silver, a breakout, that could bring some momentum back into it and it will be something we're watching. What about from the option side of things? Well, you can see here that the options has really been kind of mixed. I think this week's been pretty low on options, but today was bigger than normal. 58% calls, 42.8, 30% retail traders, And the interest was obviously in all of these things that we already expected. In particular, MSTR. We also saw some massive trades in a lot of AI stocks. The Russell as well, getting a bit of calls and puts on it. Notice though more puts, so people starting to bet against it. I think the Russell could be ripping here. We'll see what the weekly close brings. But some decent options trades coming in across that point. When we take a look at high yield junk bonds, you can see here the coil. This is both good or bad for both bulls and bears. We'll have to see a breakout and a false move down. Like if that happened, a false break, that's probably going to be a big bear reading. And at the moment, we've just come to the resistance and we've found it as resistance. So we're struggling around this area, but recently we've had that bit of a risk on and we'll have to find out. Now, this is mostly the chart I want to be watching. And take a look at this, a little uptick here. Oh, we're going to be on top of this one. So this is basically telling us whether we have a risk going through the markets in terms of bonds. So this is probably one of the better reads that we have as an early read. You can see it early read the 2024 little dip in January. It does tend to early read these. It dipped up. We're looking for a break of this high. We'll report back if it does happen. That could actually show that we're moving down to daily 20 and possibly even underneath that level. US 2-year, you can see here again, 4.77. Make sure you have an alert there. We broke to it, but we didn't break above it. If we do, the inflation trades back on. I still think this is going to be an important level for the markets because, of course, Jerome Powell's claiming a lot of things. The market's going for a June rate cut. And at some point, if they're not getting it, that's going to be a big one. Also notable here, what's going on with central bank liquidity. Central bank liquidity dropped here on the Fed and central banks around the world. So basically all of the central banks that are notable reduced their overall support of the market at these new highs. First time in a while we've seen a drop like this. So yeah, something we're noting, something we're paying a lot of attention to. We'll keep covering on that. In terms of VBR, this is something we bought up in the last 24 hours. Very strong level for this. Obviously, the weekly close will be a huge deal. New breakout. That's showing that smaller caps are now looking a lot better. And smaller caps were the focus of the last couple of days with a nice breach out here above the 2050. That was a very strong buy. And at this point, we're looking towards whether this market can actually hold a strong weekly close. So the one thing with the Russell is, as I've mentioned before, 2090 is a big level and 21 kind of 10, 2120. If we manage to get a close there, we could be looking at a pretty decent squeeze across Russell stocks all the way up to around 2250. There's not much on the left-hand side stopping this movement. And similar to like oil movement the other day, if we do get a breach out, the momentum is so fierce in these markets that it can get to that level within just a couple of sessions. Then everyone starts talking about it in the news. You'll notice the Russell is getting a little bit less rub than it was a few weeks ago. So there you go, a little bit less articles being written about it. Again, here's just an example of IWM and where we're at. So very important level. Friday's close will matter. Join us for the weekend show when we talk about that. Copper remains broken through. It remains high. It's taken a breather. This is the minor support. The major support's obviously down here. And at this point, we're looking for copper. If it breaks through 4.2, it's really just continuing that inflation-based story. And above 4.4 is going to be when everyone's going to talk about copper. We're probably a bit early there, which has been good. And we've obviously, therefore, been able to look at these metals, track them, and track energy and track a few other things. Dollar index. Now, this one surprised me. It rallied harder than I thought. I thought we'd get a rally up here. You can see the little blue line I've got. But I didn't think that we'd get this high so soon. So I thought we'd go about 103.56, around the 61.8, this area, then maybe sees dollar selling. Kind of needs to. Otherwise, if it breaks to a new high, it might have trapped a few people. Now, this is a very interesting trade, and it's leading into, of course, a whole bunch of currencies being at big zones as well. Let's have a look at the euro here. So this is coming back down. You can see here it's a deep, deep pullback after that initial rally. If it's going to buy, the euro has to buy pretty much right now. And obviously, if it gets underneath here, dollar could be long, euro could be short. And I'll need to look at the overall retail positioning. I might post that over on our X account to see what I think the next move is going to be. But at the moment, euro is really at that kind of buy for day traders. I wonder if it's going to happen. Let's move over to gold. Not a great close, not the end of the world, but now we get to mark out a high. So we're going to put a 22.25 alert. And we can see here that this is a pretty classic flag. I'd say everyone's been drawing this classic flag. You can see the movement. It predicts a 2,300 price. Bank of America just came out and claimed that they want 2,500, 2,600 on gold now. Funny how that happens when you, when of course we've been early on it, now everyone's talking about it. Over here, weekly close is going to matter. So we'll see how it ends up over the next 24 hours. I'd like to see gold hold up. CTAs have reduced, so it would make some sense. But I think the trend is still intact, of course, and we are looking for this to hold up. But that is not a great candle for it. Let's move over to the one that might end up doing better, which is silver. Now you'll notice I have a little alert here at 25.82. This has been holding for a long time. A lot of people have been saying, can you cover silver? Can you cover silver? I'll cover silver when hopefully it breaks out. This thing is super behind. It's been, of course, artificially kept down. There's all these stories of it in the future and at points. And of course, we'll be paying a lot of attention to it. If it does break out from this point, the next level for silver is going to be a fairly speedy, you would think, move to around this price, which is $28. So we'll be watching very, very closely. And of course, silver could be interesting, especially if it closes the weekly like this. If it then breaks out the next week, I think it's going to squeeze. So it'll, again, a lot of opportunities on the markets. Oil starting to struggle, hit our first big zone here. It's still around this level, but I'm not convinced by oil just yet here at this level. So you can see the weekly closure. If this happens, not good sign for oil. Starting to predict it to move back down just as everyone starts to turn bullish. Remember, XLE, which is the sector, is also trading at that res. So this is trading right at where you would see some TPs going on. If it breaks through, of course, that's going to be strong, but what a move it's had. So I wouldn't be surprised to see some consolidation in that area. PayPal, one of our stocks of last week, doing really well. This stock obviously flying high and breaking to 66.14. I'd like to say PayPal at 75 in the future. And yeah, a nice weekly close. Let's see if it can actually hold it up for once and get to a new high above 65.83. I'd love that. It'd be cool for PayPal. Let's move over here. Well, we don't really need to do GDX versus SPY, but obviously we are looking for a 0.6 ratio point for that. And you can see here AMD. Now, AMD has sold off really heavily. Of course, it's been probably overpriced, but a lot of semis are at the moment in terms of their current valuations. 23.8% down. Now, that's actually a bear market correction for AMD. And you'll notice that it's come into this level of structure. So this level of structure is pretty key. And I didn't really like how it closed. I posted this over on X as well. I like the previous sessions. So what you'll notice here is you've got some wicks. That's really good. It filled the gap, which is here, which I thought was actually quite bullish. It needs to hold these lows. Now, obviously, this is just structural. This is the first very aggressive sign of potentially some people trying to buy the dip, but it's sold off very heavily. So it's back into the structure. If markets do want to go bullish, maybe AMD needs to hold it over. Another thing that could happen is we go like this and then like that. And if that happens, that's a much better signal. But the first signs of a little bit of recovery are on the small time frames. It's certainly worth a watch. Same thing happening on Tesla. Obviously, the first signs here are these wicks with purchases coming through. We're not through the 182, so we can't be sure the swing traders are in yet. But this is a very interesting chart, and I do like, of course, the possible return point. We had it there for a long time. It hit it. Weekly close will matter. We'll update you after that. NVIDIA comes off the 920 res. So we already know that's res and support. So key levels there for NVIDIA. And we have the Chinese market as well, falling a little bit after a good PDD result, but then it couldn't hold it. And in general, it's still 2 steps forward, 1 step back. Although I would want this to probably move to a new high over the next 2 weeks. So mostly AI-based stocks and tech-based stocks for that market. Now let's move over to the Qs versus the SPY. Again, the SPY is outperforming the Qs. You can see the break from those August lows. And we also have, of course, the NASDAQ ends up at a new all-time high, rejects that high slightly, just melting up here. You can see these very slight new highs. If it ends up doing more consolidation and then drips down, that will be what we call a Wyckoff with false breaks. But at this point, it is a melt up, and that's all we can really take from it. Now you look at the Qs, again, same problem that the S&P has. It gapped up. If it sits for a few days, then gaps down, that's obviously a negative. And maybe the NASDAQ would actually be where the biggest sell is because it's probably the higher, well, it is the higher price market at this stage. Now let's move over to Bitcoin. So we know that Bitcoin above 70 is a big deal, probably looking at a new all-time high at that stage. And at this point, this is where the supply sits, 68,700, 68.5. It's coming back down. Let's have a look where day traders are going to be excited about it for the buy side. So it's pretty much sitting around almost a level that day traders would be looking at. I think a 61.8 fib would be an interesting zone as well. So it's sitting at the 38.2. That's usually the more aggressive version. This is an interesting level as well for buyers, 63.5. If it manages to get underneath 63.5, ooh, yeah, it's coming down, guys, and it's going to get kind of nasty. So certainly one that you will need to be paying a lot of attention to, but under this level, there's nothing on the left-hand side holding it. So we're probably moving into those 50 to 52K range. And we did a poll recently going through all of that. Just remember, if you're interested in anything else that we do here, check us out in the other socials, links in the comments and description down below. And in terms of upcoming information, we do have Jerome Powell annoying us again on Friday, 9 a.m. New York time. Maybe that'll move the markets. Who knows? Lots of opportunities out there, guys. Remember, come from an abundance mindset. If you're sad about losing a semiconductor, there are other stocks and other markets. There's always another opportunity. Thanks so much. We'll see you in the next one. Bye for now.